Welcome to The Pop, a podcast about America's capital markets machines. With me today is Bill Hinman. Bill has spent his career at the center of U.S. capital markets. At Simpson Thacher, you helped lead landmark IPOs for companies like Google, Facebook, Alibaba, and Square. And you shaped how a generation of internet companies enter the public markets. You were at the SEC as director of the Division of Corporation Finance. You are famous for the Hinman speech. You've inspired a lot of people inside the crypto and digital asset markets with that speech that helped define how we think about decentralization. And you're an expert in the capital market. So, Bill, thank you for joining the program.
Well, thanks for having me. Thanks for those kind words.
Yes. Let's just quick dive in with your own experiences. You've had a long career in capital markets. What has been, in your mind, the impetus for why companies have gone public, and what the sort of genesis is of them entering the public space?
Sure. Going public, meaning you're trading your stock publicly on exchanges like the New York Stock Exchange or NASDAQ, has always been a great way to efficiently raise capital, new capital to grow businesses that are going through that phase where they have enough of a runway on their business that they can tell the public about it and deliver results and raise capital in a way where now people can buy that stock, everyone, retail investors, institutional investors, not just private placement investors. And that's generally a very efficient way to raise money. Historically, companies have also used the public markets as a way to reward their employees who have accumulated stock through options and restricted plans, and now have a very convenient and easy place to sell it. So it gives the employees liquidity, and it gives the company a source of new capital.
So the current SEC chair, Adkins, has said that he wants to make IPOs great again.
Right.
Have they stopped being great? What does this mean to you?
Yeah, I don't know if they've stopped being great. They just are fewer in number. And so I think when he's talking about making IPOs great again, I think he's saying, I want to make the SEC a great place to take your company to go public. And he's trying to improve the IPO process that people experience because numbers have dwindled substantially. Various estimates are out there, but it's about 40% fewer IPOs per year now than we had just a couple decades ago. There are lots of reasons for that, and some of it relates to the SEC and the difficulty of navigating that process of registration. When companies decide to go public, they have to provide a lot of disclosure, a lot of formal financial disclosure that they weren't doing in the private markets. And over the years, that's become more and more burdensome. Also, as a public company, you're kind of held to account each quarter for how you're doing. As a private company, it may take a while to get to the place where you're starting to deliver profits consistently. As a public company, if you fail to do that, your stock gets punished. And so people are reluctant to necessarily enter that market unless they really need to. And today, there are a lot of sources of private capital that didn't exist a couple of decades ago. Private equity is much more available. Folks have kind of come up with legal technologies to stay private longer. That liquidity we were talking about for employees now is sometimes provided through tender offers while you're a private company for your employees to sell their stock and get liquidity that way as opposed to the public markets. So there's a host of reasons. The litigation risk that you face as a public company is something that people are reluctant to expose themselves to if they don't need to. And again, the process itself has gotten more cumbersome and more expensive. You also find that the coverage that you get from analysts is very limited unless you're of a certain size, and that size keeps growing. So now, unless you're a $1 billion plus market cap company, you don't get the kind of coverage you might want to have of your stock from the analyst community, which encourages people to value it correctly and to participate in capital raises that you may do in the future.
So is it a chicken and the egg problem? There's more, alternatives to going public. There's, legal technologies and private, capital available because it's harder, or is it harder because the standards are higher now because there's fewer companies?
I think it's a mix. One of the other things that's happened is there was the Jobs Act changed the numbers of shareholders you could have and remain private. So it used to be once you had more than 500 shareholders, you had to enter the public markets. You didn't have to do an IPO, but you had to become a registrant with the SEC. Today, that number is 2,000, no more than 500, which can be unaccredited investors. But that made a big difference in when people had to go public. And as they found that they could stay private longer and private money was available, it became sort of, well, why do I want to go into this increasingly burdensome system if I can stay private a little bit longer? Unfortunately, and I think this is what Paul Atkins is trying to get at, the longer companies stay private, the more very significant growth occurs in private markets and are not available to the retail investor. So, one of the things that Jay Clayton and I did when I was at the SEC, and I think Paul is trying to pursue, is trying to make more companies cross that threshold into the public sphere earlier, so some of that growth can occur for retail investors who, as you know, are increasingly dependent on their contribution plans, 401k type plans, as opposed to defined pension plans that people generally don't have anymore. So people have to make their own investments, and retail investors having the opportunity to have more growth in the IPO markets is something that I think a lot of folks think would be a good idea.
Yep. One of the things that, strikes me as, as an observer is that, these 2,000 shareholder limits, let alone the 500 ones that existed pre-Jobs Act, there's a lot of loopholes and workarounds to this, right? At this point, you have companies with they might have 2,000 direct line items on their cap table, but it's layers upon layers of SPVs. Right. And there might be hundreds of thousands of end investors who have exposure to a company before it formally files. Has this problem gotten worse?
In some ways, the issue that you're just talking about in terms of do you look through some of these shell companies, the SEC has some ability, and they occasionally will revisit those rules. I think if they feel like it's really gone too far, that there are too many, indirect holdings, and when we really count the people who have exposure here, we need to do something to protect them. That could happen. Probably not this administration, but you could see, in the future if the administrations change and that there's, a little bit more of an investor protection theory, you could see people trying to do something like that. At this stage, I don't think it's gone too far. And I do think some of these collective holdings, make a lot of sense. What probably would help quite a bit is if these intermediate holdings were more available to non-accredited investors in a way. Because right now, if you're a retail investor, you have the option of investing in mutual funds. They can only hold under SEC policy about 15% of their holdings in private opportunities. When you have a fiduciary intermediary who is sophisticated, can look at these companies, can get disclosure, that's not a bad halfway house between providing more people with early opportunities for growth and forcing everyone into a public mode.
Right. So are mutual funds and, public vehicles that can make private investments the good middle ground here, do you think, where you are creating exposure and access, but without,
I think there's something to be said for that. I mean, I think the markets have spoken on that. I think, one thing that people are always critical of the public company model about is that you become a very short-term strategy-focused company. You're always trying to make the next quarter, trying to step back and make longer-term investments that may affect your quarterly profitability is a very difficult thing to do as a public company. So to the extent we have capital models that allow people to step back for a while, make those longer-term decisions, that's not a bad thing. So finding some middle ground where investors are still protected, but a wide range of investors have opportunities for investing in growth situations, I think that's not a bad middle ground.
Yep, makes a lot of sense. Well, let's take a step back for a second and go into your experience at the SEC and some of the factors that have made going public potentially more difficult, right? From your experience, what's the process of the S1 review process look like? From the agency's side of the table, sure. What goes through the staff's heads and what goes through the sort of lawyers' heads representing the issuer? Walk me through the sort of journey.
Sure. Well, the journey is typically a pretty long one.
Yep.
Probably at least a year from the time you say, yeah, we really want to go public. There's a lot of preparation on the financial side. One of the things that people often sort of get delayed by is the accounting for the amount of time that developing public company quality financial statements requires. As you really dig in and you start to look at public company accounting, it's a very specialized field. A lot of companies have really good accountants, but they haven't done a lot of SEC reporting. And so they need to, get the national office involved of their auditors and really understand, when the SEC looks at this set of financials, what are they going to see that we're missing so far? And we don't want to get delayed by that. So let's get ahead of that. That's something that folks need to focus on. But the journey, as I say, takes about a year. Some of that is just preparing this registration statement or prospectus that people have to put everything that's basically material about their company in a written disclosure document that they're going to take accountability for and have liability for. And their underwriters are going to also have liability, so they want to do diligence on everything that's in there. So there's this tension between the issuer and the underwriter, making sure that everything in that document is accurate and complete. That takes time. So there's lots of drafting meetings. There's meetings with accountants, lawyers, company management, all to make sure that that's right, that the risks are understood and well disclosed, that what's been going on in the trends in the business and the drivers of the business is well understood. So pulling that all together, it's a great process. Companies end up knowing themselves better at the end of that than they did at the beginning, but it takes time. And then eventually you get to a state where you can file this with the SEC. When I was there, we tried to make it easier to file confidentially. One of the things that people were always reluctant about in going public was if I file and I don't make it, it's sort of a black mark. And I don't want that, so I'm going to be really careful about when I start this process. Now with wider confidential filings, people are a little more relaxed about starting a process. And, if there are delays, it's while they're confidential. They don't have to explain that there was a delay because of a supply chain issue or because of a war in the Middle East or what it was. They can, do that while they're still in a confidential mode. The staff during that period of time, the staff of the Division of Corporation Finance, where I was director, will be reviewing that document. Typically, it takes 30 days, and the staff tries to hold themselves to this, to get your first round of comments. While that's going on, you'll have industry experts, because you're filing, if you're a tech company, we file the folks that have tech expertise, or a life science company will go into the biotech group. Oil and gas, all these different industries, there's people at the SEC who really understand them well and can kind of read the business description and say, how about this risk that we're seeing other registrants in your area disclose? Do you have that problem? They pick through and try to see if everything is complete. And then there's accounting staff that will also read through the financial statements and the footnotes and just see what you're describing as your major accounting policies. See, again, your other people in similarly situated cases handling this accounting the same way? Are they doing alternate accounting? Why did you choose this method? So you eventually get, could be 100 comments from the SEC on your filing. And then you work to clear that up with amendments. And then eventually, when you're through that process, you set a time to do a roadshow where you meet with investors, describe your business to the institutional investors who are thinking about investing. And then if that goes well, you're narrowing in on where you're going to value the company, and you and your underwriter will sort that out and negotiate usually a price in a typical IPO, though there's alternatives to that.
We'll get into the alternatives.
We'll discuss, I'm sure. But you work out a pricing range and then finally a final price. And when you're really finished with the SEC, they will declare you effective, which basically means you can go forward and now offer this stock and confirm orders in this stock, and you have a closing a few days later.
Yep. Ballpark, how long is the average S1 nowadays? I've heard that it's gotten significantly longer over the last couple decades.
Ballpark, I think, 200 to 400 pages, depending on how complicated the companies are.
Are the S1s getting longer because there's more, de-risking that's coming from underwriters? Is it coming from staff? Is it coming from the fact that companies are going public later and there's just more to disclose than when they were smaller companies.
I think it's a lot of, all those things are contributing to the length.
Yeah.
The rule base has gotten, heavier. The issues that people are facing today are more complex. I mean, 30 years ago, you didn't have cybersecurity risk, right? Today, you might have 3 pages of risk factors, depending on your business, about that topic. You didn't have as much disclosure about things like COVID or climate change or things, even without the climate change rules that had been proposed and then withdrawn. Lots of disclosure if you're in a particular business where climate is important or climate change may be important. Lots of disclosure. So the world's gotten more complicated, so there's more to talk about. Companies, as you point out, are going public a little bit later generally and at a bigger size. So they may have segments to discuss, not just one main business. They may be operating internationally. There's a whole host of risks and, again, disclosures that come with that. So I think the world's a more complicated place, but contributing significantly to this is the rule book's gotten fatter.
Yep. Do you find that, investors are reading the risk disclosures, or are they looking more towards the financial side of the business and the optimism? Are they looking more towards the good things or the potential risks?
I think the professional investors are looking at all of it and trying to see where there'll be opportunities to invest in a company that has real growth opportunities. But the retail investor, I think, is still attracted to sort of the upside. One of the benefits of these long disclosure documents is even if you or I don't read them for our retail investing, someone is, and the company has to go through that process. And the professional investors are really the ones who are probably negotiating the price at the end of the day. So the retail investor is kind of a price taker, but a taker based on a hopefully very complete set of disclosures that have been very vetted by both the underwriters and then the professional analysts that are out there looking at these.
Yep. Given that, you mentioned that staff has, 30 days to really review this, as the process has gotten more complicated, has their job gotten harder? If it was 30 days when it used to be 80-page documents, do they have to work 3 times as hard now?
They are working harder. There's fewer of them and fewer offerings to go through. So that's actually helped. If you still had the same volume, you'd probably have to increase the number of staff members. I think there are more productivity tools. So I think they're probably more efficient than they would have in the past. All of that 30 days is not spent reviewing the document. Some of that you're just in the queue, waiting to get to someone's desk where you will actually be reviewed. As Paul Atkins has been talking about making, IPOs great again. One of the things that I think he can do is to make sure that time frame of 30 days and then the typically 10 days for follow-on amendments and reviews is more closely adhered to by the staff. You do see some filings getting bogged down for any host of reasons. But I think it would be really useful to kind of revisit that timeline, make a firmer commitment to it, and make a commitment that unless the company is changing something and putting something in new in an amendment, the comment shouldn't go back and make comments, 3 amendments into the process about something that's been there for three amendments. In other words, if it was there at the beginning, the staff should be compelled to make their comments early on so issuers have more ability to respond and keep things on a good time frame. I think that's something they can do. There's issues. Obviously, things change over the course of a filing. The staff needs to be able to raise comments that they feel are important. But just the idea that if it's not something new in the filing, we're not going to raise the comment. If we didn't raise it earlier, it would help and make people much less frustrated than the process. Is one of the things you see people get kind of irritated by. Why am I dealing with this in, week 10 when this has been in there?
Could have been brought up
much
much sooner. Yeah. What's the actual drafting process look like? So if you're an issuer, you have inside, the company, you have counsel, you have your executive team, you have outside counsel, you're working with an underwriter who has underwriters counsel. Who's doing the work of, really drafting this?
Generally, it's some people from the finance arms and the business arms of the company that understand the business well, working with their counsel, with underwriters counsel, and with the bankers themselves. And for most companies, they go public once, and those management teams, this is somewhat new to them. So people rely pretty heavily on underwriters who have done this as a living, the bankers and their counsel, who again see a heavy deal flow because they're constantly doing this for their clients. And they all work collaboratively, and also the accountants. And we kind of hinted at it a little bit earlier. What's really helpful is if you have accountants that have done the public offering process before in the room, and if you don't have them in the room, that you're at least sure that the national office that really understands SEC accounting and some of the niceties of that is involved early on, so that they can make sure that you're not going back trying to scramble to pull financials for some acquisition that you've done or whatever. That oftentimes the accounting is the long pole in the tent and can cause the delay. So you involve the accountants very heavily in that process.
Yep. You've seen a lot of IPOs, you've seen a lot of S1s, you've been involved from, a lot of different, perspectives here. What are some experiences you've seen where, the S1 process has gone, off the rails a bit? Like, has that come from the issuer side? Has that come from, the staff side with, questions like, when has this process not worked?
Yeah, I mean, I've been fortunate enough that for the most part, I don't think I've had anything I would call a real failure at the IPO process.
Or a thousand batting average.
Yeah, 1,000, sure. But you do see delays. We had a situation where we got to the organizational meeting where all those people were getting together for the first time to talk about getting this company public in 6 months' time. And we discovered that the accountants had an independence issue. We just asked, as underwriters counsel, we asked questions, and the firm that they were using couldn't be their auditor for the SEC process. And so it came as a great surprise to the company. It was something that delayed the deal at least 9 months, maybe a full year. So that is kind of a disaster in that setting where market windows are not always open. You're trying to hit a window and raise capital that you need, so delays are costly. You do see situations where companies are slowed down by the SEC because they've been out and talking to the public outside of the prospectus, and so there's a cooling off period that gets imposed from time to time. That's not a happy event because, again, you're setting everything up to hit a particular window, and now all of a sudden you're delayed a month by the SEC. That has happened.
How does the cooling off period work? Is it, is it a policy matter? Is it, walk me through how this is structured.
Yeah, it is a policy matter, and it basically reflects the idea that if you're going public, you should really be talking to investors through the prospectus where you're taking real liability and there's certain rigor around those disclosures, not casual statements in the press or in offhand meetings. And so if a company does enough of that, sort of offhand selling of the company outside that prospectus, the SEC can say, look, we're going to slow you down. That Wall Street Journal story that you sponsored or were participating in is something we want to see sort of fade away in terms of its importance and how you're selling the stock. And so you're going to not be declared effective and allowed to start confirming orders for 30 days. That is an event you don't want to see happen. Like any delay. You do see delays too for other reasons. You see it for, a company wants to do an acquisition and it's strategic enough that they say, okay, let's hold on to this offering for a while, pull together the financials and all of the details around this so we can disclose it. We can't do it, we can't fix the plane while we're flying it, So you have to do the acquisition, set things aside for a while, and move forward with that.
Yep. In terms of, M&A or, a material event, how material does something have to be to sort of like forcibly reset the clock or the financials on the issuer side?
Well, there are, some very highly prescriptive rules around materiality when it comes to M&A events and probability of those events that are complicated. It's one of the things that people sometimes get wrong and sometimes get called on by the staff to say, no, that is an acquisition that is material under our standards. And so go back and pull together the historical financials and the pro formas, and that takes time. So that's another area where people can kind of get sideways. But yeah, that is an area that you have to be careful with.
Yep. One of the companies that you worked on, Google, I've heard an interesting anecdote about, statements to the press when they were, going through their registration.
Right. Yeah, so Google was interesting in a lot of respects. They were trying to do something called a modified Dutch auction, where the pricing of their deal would be set up through a clearing price that would clear all the shares that they wanted to sell, as opposed to a negotiated price, which is typically done where the underwriters, talking to institutional investors, develop a sense of the company's valuation, and they negotiate with the company the final price at which the stock will be sold. Google had a different idea. They thought it would be more efficient and a better price discovery mechanism to use an auction.
And theoretically, that is a better method. Philosophically.
Philosophically, it is, and there's a lot to be said for it. And auctions have been used in lots of security sales over the years, so it wasn't completely novel, although it is somewhat novel for IPOs. The process became a little bit more complex because they needed to get people registered to do an auction. They had to explain the auction rules. It took some time. The SEC was actually quite supportive of an auction being used because at that time there had been a lot of criticism of the process that people have been using up to then, which is this negotiation between the institutions and the underwriters. There was a thought that had gotten to be too cozy, that institutions were taking some deals to get other deals, and people were a little unhappy with how that process was working. So the Google guys decided, let's do an auction. They did. Went through all the things that we've been talking about, how you prepare a S1. And then toward the end of that, we were informed, I was representing the underwriters, that the company had actually done an interview with Playboy many, many months ago, and Playboy had decided to put it on the shelf and wait till it was newsworthy. Well, it was newsworthy when the IPO was happening. So this looked like it was potentially a cooling off problem. And that Salesforce.com had just been cooled off for a story that had been running in the Wall Street Journal that they had cooperated with. And so it was like, okay, now it's our turn to get cooled off. Fortunately, we were able to convince the staff that because of the way the auction was working, that this particular article wouldn't have the ability to influence investors because it was going to show up after people were registered for the auction. Before the pricing and before
they bid.
Investment decisions, people had to register, and the article was going to come out, after that registration. It still could have some impact, and the staff was open-minded about it, and they said, well, we just cooled off Salesforce, give us, a complete rationale here is why we shouldn't cool you off. And between the registration having closed and the willingness to take liability for the statements that were in the interview by putting the interview as an appendix to the S1 registration statement. So if you look at the Google prospectus, there's the Playboy interview of the founders and Eric Schmidt attached in something which the company took 33 Act liability for. So, yeah.
And when Google was, going through this process, the auction mechanism was basically untested for an IPO. How much do you think of its success or failure came down to the fact that it was being done for the first time, right? If they didn't have to wire up the broker-dealers into an auction mechanism, if this was like the fifth, auction-based IPO, do you think it would have gone differently?
Yeah. So, you're alluding to the idea that maybe the auction wasn't as successful as people had hoped, and that's right. The bankers had built a model that would allow millions of bids to be put in. The Google fellows wanted a very open process where any investor could bid any amount in any increment through a very wide range of broker-dealers out there, so that this was a very wide open auction, the thought being that would give us the best price discovery. That really was novel. And in that process, I think the institutions which were used to getting their allocation of IPOs through negotiations with the underwriters were somewhat unhappy that this old model was going to change, and they would have to bid. And they didn't know which bids would clear. They didn't know if they were going to be able to even participate at the bids that might clear, because retail might be the 100% of the buyers because it get bid up so high. So there's some institutional reluctance to get engaged. And then I think retail may have gotten a little spooked by the disclosures around the Playboy interview, and that was in effect an illegal offering that could give rescission rights. There were some other things in the disclosures where we were trying to make people very aware that an auction is a new novel method. If you are bidding the clearing price and you get to participate, you may be at the high end of the range that will be sustainable over time. And I think people were reluctant to engage and put bids in, or aggressive bids. So the price range originally was $100 to $120. The deal actually priced at $85 because there were not enough bids at the higher prices, and people had to kind of go back to the institute. The underwriters went back to the institutions and said, the auction's not giving us the price we wanted. What would you buy this at? And so it eventually cleared at $85.
So it was an auction mechanism with some like soft traditional underwriting behind the scenes.
Yeah, at the end of the day. Subsequent to the Google IPO, other people had more success with that model, but it's not really become the main way people do public offerings. There are other alternatives that people are pursuing, but the auction is occasionally used, but not all that frequently anymore.
Yeah, I feel like most IPOs now are still following the very traditional,
Right.
run-of-the-mill underwriter-led
Right.
price negotiation process.
Right.
Do you think any hesitance or reluctance towards more novel mechanisms is coming from the investor side? Is it coming from the underwriters themselves because they have a working process? Is it coming from regulators? Like, what are the hurdles right now? Where are they coming from?
Yeah, I think the hurdles are people are always a little reluctant to try something new when it's that important. There's a one-time event for the company to go public.
You don't get too many second chances.
You don't get a lot of
public.
second chances. And if it doesn't go well, that's a badge you carry for a while. So people have been reluctant, although, there have been some innovators. Spotify is probably the best example we can talk about there, where Barry McCarthy, their CFO, didn't really need to raise capital, but he did have investors who were looking for liquidity, the liquidity you get as a public company. Because he wasn't raising capital and because Barry had been around Wall Street long enough that he understood the foibles of the pricing mechanisms that are used in a traditional IPO, particularly the 15% IPO discount. You typically would price your IPO at lower than where it might really ultimately trade, just so it was a success. So you had a pop in your IPO. So
the namesake of our show.
Exactly. So if you need a pop, then you're going to sell it at a discount. Barry didn't like that idea, especially because he wasn't going to raise money himself. He wanted to see his stock do well for his investors. They had registration rights, which meant the investors there could tell the company at some point it's time to go public, and they were doing that. So instead of doing a conventional IPO, he did this thing called a direct listing, which I was at the SEC at the time. We met with them. And we found a way for them to sort of modify the rules to still do a 33 Act registration where people are taking responsibility for all that disclosure and going through that process we just talked about. But they weren't letting the underwriters and the institutions price their deal. They were letting their deal be priced by the opening trading on the New York Stock Exchange. So even for every IPO, as you get close to opening the trade, there's a sort of come to Jesus moment where the people who own the stock and the people who want to buy the stock are entering orders, and they'll do that through the banks. And the banks will figure out a price at which they can open the stock for trading that they think will be stable and it'll trade well. So Barry was saying, that's the price I want to see my stock trade at. And so he did this idea of a direct listing. We worked with him on some of the rules that needed to be modified to allow him to do that. And we at the SEC saw this as, okay, the traditional IPO model isn't working for everyone. We want to see more companies go public. If there's a way to still protect investors, still get that 33 registration, but do something that works for a group of companies, let's do that. And then after Barry did that, a number of other companies have done it. To date, all the direct listings have been done as secondary offerings. In other words, the company's not raising any money for itself, which in many IPOs, that is the point. So it doesn't work for everyone so far. There is a method, and we talked to the banks and we talked to the exchanges when I was at the SEC about how to layer in a primary offering as a direct listing. And Both exchanges have rules that would allow for that based on the guidance we gave them, one of which is if you're going to do a primary direct listing, you need to make sure that those primary shares are actually going to trade on that open. And then a little bit more information about a price range that the company's looking for, which in a secondary where the company's not setting a price you don't need. Now, if the company's doing a primary, you do need that. So there's a way that people can do a primary listing. And I think we'll start to see it. I think this administration, this chairman, looking for ways to encourage companies to go public, will likely find a way to signal to the markets that you will work with you if you want to do a primary direct listing. So I think that is one avenue that people will use.
Yeah, I mean, it'd be great to see more experimentation,
right.
With the support of regulators,
right.
To try slightly different models here.
Yeah, I think the whole idea of the regulator being collaborative there is really very useful because, again, for all the reasons we've been saying, it's good when companies are public. For the company itself and for the investing public. So if there are ways to get past some of the hurdles that have grown up over the years, I think the SEC should be embracing that.
Right. I mean, one size definitely doesn't fit all
Exactly.
when it comes to how a company raises capital.
Exactly.
I mean, if you look at private markets, almost every startup does things differently. There's a ton of ingenuity, at all of the private fundraisers.
Right. Right. There's been a lot of financial engineering that's done there. And many times you can learn from that if you're, the SEC. Like we revised the rules on securities disclosures based on what the private markets were doing because we saw very sophisticated investors wanted this package of disclosure. Our rules were asking for something else that was incredibly cumbersome, time-consuming, and didn't really give investors the information they needed and wanted, which we could see from the private markets. So we learned from the private markets.
Yep. Do you think that there's more lessons that are going to be taken from the private market and used by companies when they go public, either in the types of securities being offered, in the approach that they're taking to selling shares either by the company or by existing shareholders? Or do you think we're at a point now where we generally understand the tools that are available and we have to decide how to use them as a society?
Oh, I think, the financial markets will continuously innovate. You do see new types of offerings. The SPAC market was a way to go public, had a lot of issues. Unfortunately, the SEC, instead of sort of recognizing it, there's a signal here to us. People are trying to find yet another alternative to the traditional IPO market. How can we make that work for investors and for people trying to raise capital? I think there is a way to approach some of the things that people found attractive in the SPAC market, in particular, giving more guidance in our current framework. And the SEC should learn from that and not just sort of crush that technique because there were problems, but there's things that need to be learned there. And then I think there's a lot of benefit in trying to accommodate offering processes around those. In terms of, types of securities, a whole area of innovation that we see right now is in, tokenization of securities. You're involved in that. I do think, that will improve settlement processes. It may improve companies' ability to communicate with shareholders, which
I think so.
Yeah.
I mean, when a company has a closer direct relationship to a shareholder, that's one step away instead of like 5 steps away.
Right.
There's potential benefits.
Benefits there. And, it also probably makes it a little easier for people who do want to hear those communications to get them. And for people who traditionally have been objecting beneficial owners, they don't want to hear from the company. They don't want the company to actually necessarily know who they are. Tokenization can actually help there too. So it kind of makes the capital markets more attractive. Whenever the capital markets are more attractive, cost of capital goes down. So, innovations like that will occur and should be good. Other sort of techniques, we saw the Pershing Square IPO where, a closed fund, which traditionally, if you take a closed mutual fund public, it'll trade at a discount. Bill Ackman tried to come up with a way to also give some shares in his advisory business to people to tamp that down a bit. I think the jury's out as to whether that really worked. But it's an innovation where people again had to probably get some issues resolved with the SEC, and the SEC worked with him, so he was able to do something innovative. I think it's really incumbent on the regulators to engage that way and collaborate that way.
Yeah, seeing a dual security IPO is very interesting.
Yeah. Yeah, you do see that from time to time. But again, I do think people, want to fine tune the process. A lot of that auction model made a lot of sense. It wasn't adopted broadly, but we're starting to see people before the pricing in a conventional IPO, in effect, use auction techniques with the institutional investors to figure out where demand really is. So it's being done. It's just not being done through bidding in the IPO. It's being done one layer down.
Yeah, I mean, in the private markets, most fundraising rounds seem like an auction of sorts for a company's going out and saying, who can write me the highest term sheet?
Yeah. And some that can backfire on people.
Of course, sometimes you take worse capital.
And then there's innovations there where, and it actually explains some of the delays in IPOs where people did these offerings where there was a preferred, where if you actually, after you're a late stage investor giving a very generous valuation, if the company wasn't going public at that price, it was going to be the IPO was a down round, their stock repriced. There was enough of those done that I think it relates to some of the delays in IPOs, that people don't want to take that down round IPO, so they're waiting for the valuations to catch up with that late stage investment that was used some innovative technology to price it very fully, but now the company needs to catch up.
Yeah, I mean, whether it's a private market or a public market, ratcheting something down is incredibly difficult to deal with.
Yeah, it's not a good day for your investors or your employees. Typically, the employees and their options get much heavier dilution through these mechanisms that we're talking about. So again, it's a good reason to delay an IPO, to let your valuation catch up with where you priced your last private round.
Right. And the technology for, secondary liquidity for these companies and their employees has been increasing over time, right? Sure. If it was the 90s, you didn't have the tools to really offer broad liquidity, while you were still private.
Yeah, it was unusual and people just didn't, have the experience with it. I think Facebook may have been one of the, companies where it went very well for the folks that funded that auction technology. Yuri Milner came in with a late round at a decent valuation. They used his funds to do a tender offer, and he ended up investing in Facebook at a very attractive price. At the time, it looked very high. In hindsight, many people saw that and said, actually, maybe some of these late round investments are good and can pay off. And so you saw more of them. And more people were like, how do they do that? Interest in the technology became wider spread. And again, one of the reasons people don't have to always use the public markets to get liquidity for their employees, and so fewer IPOs.
Yeah, just the other week, Anthropic had a tender for its employees that will probably look like a phenomenal investment at some point.
We don't know, but we hope so.
What do you think, will change about the IPO process, in this administration or the next one? Do you think that, we're just going to see more IPOs occurring if the process gets, a little bit more flexible? Do you think that we'll see the same quantity of IPOs, but there's just going to be more, flexibility on the issuer's behalf to customize the way they go about it? Like, what do you think the world looks like in a couple of years?
Yeah, hard to say, but I do think this administration is going to do their best to try to make sure that the offering process and the disclosure obligations are as fit for purpose as they can be, so that you might see more scaling of disclosure for smaller issuers. So these companies that haven't gotten the size that can support the cost of being a public company, maybe you'll have a lighter set of disclosure obligations, or stay emerging growth companies longer. I mean, see the chairman talking about things like that. So I think you'll see more scaled disclosure. I think they're experimenting with the idea that maybe people can report semi-annually instead of quarterly. I don't think that's going to be a big mover, but for some companies that may be attractive enough. You generally see public companies wanting to report quarterly because their investors want that information, and you see foreign issuers who have the flexibility of only reporting semi-annually, usually because the SEC rules say, even if you go public in the United States, if your local rules don't require quarterly, you can do semi-annually. Many of those companies do quarterly because they know their investors want it. So whether that's a big one or not, we don't know. But I think the rule base will get better. I think the chairman has made it very clear in a policy statement that the SEC will no longer delay effectiveness if you have arbitration provisions instead of, general securities provisions. So people can be required to sue through arbitration as opposed to class actions. Delaware has sort of been pushing back at that and saying that you cannot have those kinds of bylaws in a Delaware corporation. Other states like Texas have said, no, that's fine with us. So you'll see some migration. I think you'll start to see people choose that. And again, if you can reduce the litigation risk of being public, that will help. So I think there's going to be a cumulative, set of small changes which may add up to more people using the public markets and using them appropriately. How much blockchain technology, tokenization, automated market makers, how much all of that changes, I think that's to be seen. I think there'll be some areas where those are really helpful and meaningful, and then I think there'll be other areas where they stay on the periphery.
Well, I definitely think the biggest advantage that tokenization of blockchain will offer is the ability for issuers to potentially bring more experiments to bear, right? Where society as a whole will see, slightly more, shots on goal of like different approaches to raising capital, to communicating with investors and to trying new things that hopefully, the positive outcomes of that can like channel back towards the IPO markets in general.
Yeah, and you'll see some enterprises that are not traditional companies.
Yeah.
I mean, we're starting to see this, in the digital asset space, and we have Congress on the eve of hopefully passing some legislation that makes it clear that for certain digital assets that have, reached a certain stage where you don't have a management company behind them and you have asset that's driving its value from the network that's built around that token, that can be regulated in a different way. And create enterprise and create value, can create, additional kind of social network and create ways to interact with AI that are different and ways to get compensated for the data that you may contribute to a large language model. Those will be new types of enterprises. They'll need capital, and they might not fit into the traditional security system. So I think we're going to see a wider variety of ways to raise capital and the enterprises that get formed around that.
I hope so. I mean, there's always been new types of enterprises, in the history of our securities laws. We've made, room for things that look like asset-backed securities. We made room for things that look like loans. We made room for all these different new types of assets in our rules. Of course, cryptographic or AI, based assets, will have a place and they'll function differently. So
I think that's right. And I think it's one of the challenges that regulators face. They have these innovative technologies and they have an old set of rules. The 33 and the 34 Act, those are years that, almost 100 years old, right? So, but if you're a regulator and you want to protect, one of your mission statements is to protect investors, it takes a long time to adopt new rules, let alone get a law passed. So you're kind of faced with, how do I protect people with this rule book, which may not be totally fit for purpose? And so you try to adopt guidance and you try to, do some exemptive relief, but it's a challenge. And so, the regulators have their hands full given how quickly innovation is happening, to try to keep pace. But I think it's really important for them to have that almost as the SEC has three missions, protect investors, orderly markets, and facilitate capital formation. I think they should be thinking about, and be abreast of technology and innovation and support innovation, just as almost as a mission, because they have to do that just to protect, to reach the other three goals.
Right. Well, with good technology, you can do all three, right? You can use new technology specifically for capital formation, creating orderly markets, and protecting investors all at the same time if you're thoughtful.
Right. But again, so much is happening and so quickly.
Yeah.
It's hard for an investor it's hard for a regulator with a regulatory mindset where you don't really get rewarded for taking risk. But, the downside is always looms larger than the upside for a regulator. It's hard for them to go there, but I'm encouraged by what the current chairman is saying and how he wants to make IPOs great again. I think he wants to make the SEC great again and to stay, abreast of this innovation and to facilitate it.
Yeah, I mean, I imagine it's a tough job because you probably aren't getting credit for American capital markets succeeding, but you certainly get blamed when things go wrong.
Absolutely. That's that dilemma that, the regulator mindset is very different than the innovator's mindset in terms of, and naturally so.
Yeah.
The innovator gets rewarded for taking risks, whereas the regulator can get punished for taking some risks that don't turn out very well.
Yeah. I'd like to leave the audience with, one thought about where you think capital markets are headed. When you were at the SEC, you gave the Hinman speech, which really laid out a vision for how, crypto assets are different than traditional securities.
Right.
Do you have any other profound views of just where you think, we should all be looking as, markets evolve?
Yeah, nothing as profound as when Howie met Gary, which was the name of that speech, named after two seminal securities law cases. But, I'm not sure where they're going. I do think, you've already touched on the idea that there's all these different techniques that people are experimenting with. I do think maybe some of the lines between private markets and public markets will become less distinct. I do think information is so available that even if you're in the private market, that information is going to get into the system. People will have a better idea of what's going on in the private sphere. And it won't be quite the hurdle either to jump into the public sphere. So I do think there's maybe, if you're asking me, 10 years forward, I do think it'll look very different. I don't think those lines will be the same. And I hope that they're changing in a way where the U.S. capital markets, which have been, some of the best in the world, and a real asset for all of our country, and drives our economy in many, many ways. I think we're going to continue to benefit by that innovation and by those lines being less sharp.
Bill, thank you.
You're very welcome. Thanks for having me.